Is this 2008 all over again? Well, that seems to be the consensus amongst a lot of people sitting on the sidelines waiting for a housing crash. It's probably the most common comment that I get on videos when talking about the housing market is people just go back and say this is 2008 all over again. We're going to see another housing crash. You know, prices have passed where they were in 2006 to 2008, and because of that, prices have to come back down. In today's video, we're going to break it down. We're going to talk about the differences in 2008 versus now. What drove the market back then versus what's driving the market right now. We're going to talk about payments back then. What did monthly payments look like on properties back in 2008, 2007, 2008 versus what those same payments look like on properties today. We're going to break it down for you and help you understand that this is a completely different environment on the lending side and on the real estate side from what we saw back in the 2008 market. And you know, to start this video, let's talk a little bit about 2007, 2008. I was a real estate agent back then. I've been doing real estate for nearly 18 years. And actually back then I was more on the lending side than I was on the real estate side. So I can talk to you, about exactly what was happening with loans back then, because that was really the key driver in the real estate market at that time is the financing side of things. Back then we had a 10.5-month supply of homes. So we had a lot of inventory out there, a lot of available homes for sale because there was a lot of construction going on, a lot of new building happening all over the place. And so there were a lot of properties. In addition to that, you had buyers able to go out and get loans with very little to no documentation. So they could get a 30-year fixed if they wanted, or they could get an adjustable rate mortgage, 3 to 5 years in some cases, and even some cases they could get a negative amortization loan, where that means that you're not even paying the full principal on the loan and you're actually adding to the back of the loan every single month you make your payment. So back then we had loans that were neg-am loans, short-term loans, those adjustable rate mortgages, up to 100% financing. In some cases, you could do 105% and 125%. So you could borrow more than the home was worth. And back then, you also had appraisers that you could call, and people were paying off appraisers to get values on properties to come in, right? So that the lenders would actually lend the money. And a moment ago, when I talked about little to no documentation, you literally had to state your income. You could say your occupation was whatever, and you could say that you made $10,000 a month. There was no documentation to back that up, right? So back then you had a lot of supply of homes, very little to no documentation when buying a property, no down payment on the property at that time, and you had appraisers kind of working in your favor to some extent, not personally, but that's what a lot of was going on back then. And then you had negative amortization loans, right? So loans that didn't really, pay the principal, as I mentioned a moment ago, and just continued to add to the balance of those loans. And so that was the environment we were in back then. And what brought that market down in 2008 was essentially the mortgage-backed securities, the tranches that they were selling on the secondary market out there. Not to get into a lot of detail, but basically what happened is these loans started to default, right? People's adjustable rate mortgages started coming due, and when they came due, they could no longer refinance because their property values had actually declined. So now they owed more on the properties than they were worth. So people couldn't refinance, they couldn't get out of those loans, and it was just this whirlwind, if you will, and it was a global issue. It wasn't just here in the United States. This was something that happened globally because there were a lot of people buying these securities on the secondary market. So this affected a lot of people. Now let's fast forward to 2020. 2020 is a market that's built around documentation. If you're a borrower and you're coming to buy a house, you have to document your income, you have to document your assets. It's a process. It's not as easy as just calling your lender saying, "Hi, I want a loan. This is how much income I make." You have to document that. And anybody going through the process of buying a home, whether you're a first-time home buyer or somebody that's bought several homes, you know that it's an arduous process, right? There's a lot of documentation that goes into it. They're dotting the I's, crossing the T's, asking you about every little nuance in your checking account to make sure that the information is valid, where that's completely different from the environment back then. Right now, as a nation, we have somewhere on average around 2 months supply of homes. So we have a sixth of the amount of homes that we had on the market back in 2006 to 2008. So a lot less property on the market. Interest rates right now are half of where they were back then. So interest rates in 2008, somewhere around 6.5%. Now you could do interest-only loans, you could do the adjustable rate mortgages, but most of the rates given back then were somewhere around 6.5%. Interest rates right now on a 30-year fixed are somewhere around 3%, 3.25%, give or take. So interest rates are way better than they were back then, and we're gonna break that down in a moment and show you what the payment difference is between 2006 and now on the same mortgage, with a payment back then versus a payment now, and help you understand why this isn't the same thing. And right now you have demand, right? You have a lot of buyers coming to the market. There's not a lot of new construction like there was back then. So you got a lot less property coming to the market. And part of what's created this inventory issues is the restrictions they put on home builders back after the last housing crisis, right? They came up with restrictions so that there wouldn't be overbuilding. And that's what started this process to where we are now. And that's why we have, so few homes on the market, in addition to some other things that's created this inventory shortage, if you will. So, back then, no documentation. Right now, a lot of documentation, not a lot of homes on the market. Demand is super high due to no inventory and low interest rates, right? And so people want to compare housing prices back then to housing prices now. They want to say, well, we crashed because of the home prices right then. They reached too high, the market crashed, and the market went down, and now home prices are back at those levels and higher in most cases. And so people want to associate the home prices that we're going through right now with the home prices back in 2006 and say that's the reason that we have to have a crash, because home prices have reached that peak again. Understand, the cost of things go up over time. When your grandparents bought a house in the 60s, they paid a lot less money for that property than they would today, right? The cost goes up over time. It's, inflation, things get more expensive. That's no different with housing. And when there's less housing out there and there's higher demand, prices go up. It's no different than going to Walmart and wanting that TV, during the Black Friday sale, and they go out and they say there's only one left. People would be willing to pay more for that TV because there's only one left. Same thing for housing. That was a bad example, but you get the idea. And so, let's look at payments back then, right, versus payments now. Back then, if you took a $500,000 mortgage and you say the average interest rate back then was somewhere around 6.5%, the payment on that mortgage back then would have been $3,160. $3,160 for a fully amortized payment back then. Well, you could say, well, they didn't do fully amortized payments back then. They were doing interest-only payments. Okay, that same payment, at interest-only was $2,708. Now, fast forward to 2021, 2020, 2021, that same mortgage today at a 3% interest rate is $2,108. So it's $1,000 less than it was back then. And as we've discussed, people live in the payment and not the price, right? So people are, more worried about what their monthly payment is than how much they paid for the house, because that's what they have to come up with every single month. So understand, the environment that we're in right now doesn't mimic 2008 at all. The only similarity is that the fact that housing prices are getting more expensive, and they're getting expensive really, really quickly. Now, I do think there are problems with how quickly the market is moving right now, with home prices going up, 7, 8, maybe 10% a year over year, and that could happen for a couple of years in a row. That's not a good thing. But it's completely different than what happened in 2008. So if you're sitting on the sidelines thinking that, we're going to see a housing crash just because home prices are continuing to climb, that's not what caused the last housing crash. The last housing crash was caused because people were able to get liar loans, which means they didn't have to document anything. They could lie about their job, their income, whatever, and still get a loan. They didn't have down payments back then. People have down payments now, and we've talked about it. And people have more equity in their property right now than they've ever had in the history of owning property. In addition, last year, people had more savings in 2020 than they've ever had, than it's ever been documented. So, people have more money in the bank, and I get it. There's a lot of people out there suffering, and there's a lot of people that went through some turmoil in 2020 with the pandemic, and there's a lot of people that have been affected. But the majority of people, based on everything out there, have fared pretty well through that. And with that, they have equity in their homes, they have savings in the bank. And these are the same people that are moving in and buying property right now. And so that's why you're likely to see this continue for some time, is because, if you're looking at, it's not the same. You can't compare a home price today to a home price back then, because interest rates are half of what they were now back then. And so, people can afford way more property today for less money than they could back in 2006, when they were lying about their income and there was no documentation or down payments or what have you. So, for those of you out there that want to continue to use 2008 as your example, I would tell you it's not one that is similar to this market, right? This market has different issues, if you will, than back then. Right now we have forbearance looming out there. We've got the foreclosure and eviction moratorium that's looming out there, but that's not something that's going to be corrected in the short term. That's going to take months, years to go through in some cases. And so, you're not going to see available homes for sale, supply double overnight or triple overnight. It's going to take months for that stuff to trickle to the market and for it to really have an impact on the housing market. So if you're somebody out there that's thinking that you're going to be able to capitalize when all of this goes down, I would tell you that you've got some time to wait. I know people that have been sitting on the sidelines for years thinking that the housing market was going to go down, and it hasn't. I'm not here to sell you anything. I'm here to provide you information and to tell you that it's a different market than it was back in 2008. But that's where we are now. I'm sure a lot of you are going to have comments, tell me that I'm crazy and that the market is completely different these days, and we're more or less mimicking that same thing. And I welcome the comments, but understand, back it up with some proof of information, because again, this isn't 2008. But anyway, I look forward to the comments below. I always appreciate the support. I'll continue to put more information out as I have it. Hope to see you again soon. Have a great day. Bye-bye.